Good morning. Welcome to Market Monday for July 15th, 2024. Last week, the Fed had its semi-annual report to Congress, giving testimony to the Senate on Tuesday and the House on Wednesday. Notably, Fed Chair Powell struck a more balanced tone, saying the U.S. is no longer an overheated economy, and we are well aware that we now face two-sided risks and can no longer focus solely on inflation. So, what does that mean? When will Powell finally cut? It appears there's a small chance of that at July's Fed meeting, currently showing a 91% probability of holding rates steady. But looking to the September 18th meeting, a cut starts looking more probable, showing an 83% chance of a cut in light of a cooler than expected inflation print last week. Of course, these probabilities can and do change every day. That would be a welcome sign to many, especially as things like auto loans, new auto loans hitting 8.65%, the highest since 2001. Bearing in mind, do you see how high rates were throughout the mid and late 90s? From 7.5% to over 9.5% during one of the strongest bull markets on record. So, as history would show, both can be true at the same time. Speaking of rates, inflation, and how it all relates to the stock market, we often like to revisit what we call first principles of investing. Why own stocks in the first place? Yes, we like to see gains and growth, for sure. But we feel one of the most noble reasons for owning stocks is to keep pace with inflation over long periods of time. Have a look. Starting in 1953, we're looking at the inflation-adjusted growth of stocks, bonds, gold, and home prices. We see homes here in orange definitely outpaced inflation, so not too bad. Bonds did too, as did gold, despite a volatile ride. But look at stocks. Despite wars, inflation, political challenges, global pandemics, stocks chugged right along, far surpassing inflation and growing way more than other asset classes during this time. Going back to a video from a few weeks ago where Chad was talking about time horizon, why time horizon or investing horizon is so important to us, a lot of common thinking would say, as you get older, you should have less stocks because they're volatile. Fair. If that's the conclusion you and your advisory team come to, great. There are other reasons to own stocks well into retirement, because after all, inflation doesn't stop when you retire, and in fact, may even become far more impactful as the years go by. Revisiting a topic we've been talking about lately, concentration, where only a few stocks are responsible for most of the gain in the S&P 500 this year. Here's the regular S&P 500 in dark blue, way up here. Here's removing just the one stock NVIDIA in light blue. And this red line is removing the so-called Magnificent Seven stocks, mainly tech stocks like Apple and Microsoft that have been market darlings for the past decade. So even without the Magnificent Seven, the rest of the S&P 500 is up about 4% for the first half of the year, which, oddly enough, is roughly what the market gains on average for the first half of the year. So even taking out the big winners, the market is still having an average year. And today we'll leave you with, for the first time in 60 years, the US is now producing more oil than it consumes. Have a great week.